You believe intelligence protects your money. It doesn't. In fact, intelligence often makes the losses more expensive. The most expensive mistakes I've seen were made by people with elite degrees. People who managed funds. People who described themselves as rational. When you allocate capital at scale, one fact becomes clear very quickly. Intelligence is not the same as control. There's a common assumption that being smart gives you an edge with money. That higher intelligence automatically translates into better decisions. I used to believe that too. But the most damaging financial decisions I've witnessed were not made by uninformed people. They were made by individuals with advanced degrees, people who had studied markets for years, people who were responsible for managing large pools of capital. When you work close to capital flows, patterns become hard to ignore. The issue isn't access to information. It isn't technical knowledge. And it isn't analytical ability. You can understand probability models and still freeze when volatility increases. You can build long-term projections and still abandon them when short-term pressure rises. Intelligence does not eliminate fear. It doesn't remove ego. And it doesn't prevent overconfidence. In fact, in many cases, intelligence amplifies these tendencies. The smarter the individual, the more sophisticated the explanation becomes. The reasoning sounds solid. The framework appears consistent. But underneath, the behavior often follows the same familiar pattern: buying near market highs, selling during panic, increasing exposure to defend a previous decision, holding a losing position longer than planned. From the outside, it looks irrational. From the inside, it feels justified. That is the gap. Intelligence gives you tools. It gives you language. It gives you models. But it does not guarantee control when pressure builds. And financial decisions are made under pressure. The myth sounds simple. If you're smart, you'll be good with money. It's an attractive idea. It connects academic success with financial success. It suggests that the same traits that help someone perform well in school or build a career will automatically transfer into investing and capital allocation. For many people, that belief feels logical. Intelligence helps you process information. It helps you recognize patterns. It helps you understand systems. So it seems reasonable to assume it will also protect you from financial mistakes. But markets don't respond to intelligence the way classrooms do. In school, correct answers are rewarded. In markets, outcomes are influenced by variables you cannot fully control. You can analyze a company correctly and still experience losses. You can identify long-term value and still face short-term volatility that tests your resolve. The myth persists because it's comfortable. It gives a sense of order. If financial results depend mainly on intelligence, then the solution is simple. Learn more. Study harder. Refine the model. And so people continue searching for better forecasts, more data, more complex strategies. They assume the missing piece is knowledge. But many of the individuals I've seen struggle financially did not lack information. They lacked consistency in behavior under pressure. The belief that smart equals good with money reduces financial decision-making to an intellectual exercise. In reality, it is something else entirely. And that difference changes everything. The idea that intelligence guarantees financial success doesn't exist in isolation. It is reinforced from multiple directions. Educational systems reward analytical ability. Strong grades, advanced degrees, professional certifications, all signal competence. The structure suggests that more knowledge leads to better outcomes. That pattern works well in many fields. Financial media builds on the same assumption. Complex explanations are presented as necessary. Detailed forecasts are framed as insight. The more sophisticated the language, the more credible it appears. Then there are the sellers of complexity. New strategies, advanced tools, exclusive research. The message is consistent. If you just understand more, you will perform better. This ecosystem depends on one core belief, that the problem is insufficient knowledge. As long as people believe that, they continue consuming information. They continue refining models. They continue searching for the missing variable that will finally provide certainty. But markets do not reward complexity by default. They do not guarantee results to the most informed participant. In many cases, additional information increases activity. It increases adjustments. It increases reactions to short-term movement. And increased activity does not necessarily improve outcomes. The myth remains attractive because it aligns with how we are trained to think. Study more. Analyze more. Optimize more. But financial pressure does not disappear when your model becomes more detailed. It simply tests something else. When you manage capital long enough, you start noticing what actually drives decisions. It isn't always the model. It isn't always the data. It's identity. Intelligence creates a quiet assumption. If I understand the system, I can control the outcome. If I've analyzed the probabilities correctly, risk becomes manageable. If the model is sound, the result should follow. But understanding probability does not remove discomfort. Knowing the long-term strategy does not silence short-term fear. When markets move against a position, the reaction is rarely neutral. There's tension. There's resistance. And for many intelligent people, there's something else. The need to be right. Status becomes connected to accuracy. Being wrong is no longer just a financial outcome. It feels personal. So instead of reducing exposure, they average down. Instead of exiting a losing position, they defend it. Instead of reassessing calmly, they double their commitment. Admitting a mistake often feels more painful than absorbing a loss. I've seen entire organizations hesitate to reverse a decision because it required someone at the top to say, "We were wrong." The illusion of control is powerful. Intelligence reinforces it. You build a framework. You understand the variables. You believe you can predict the range of outcomes. But markets do not cooperate with personal confidence. Fear of loss can override strategy. Ego can override discipline. And when that happens, intelligence becomes a tool used to justify behavior, not to guide it. At some point, the framing has to change. Money does not live in formulas. It lives in behavior. You can build an elegant strategy. You can model different scenarios. You can simulate risk across decades. But when real capital is exposed to uncertainty, what matters is not the brilliance of the model. It's the consistency of execution. The most stable portfolios I've seen did not belong to the most intellectually impressive individuals. They belonged to structured systems. Systems designed to limit damage. Systems built around rules that were followed even when it was uncomfortable. Intelligence often prefers complexity. It looks for optimization. It searches for an edge. Capital, on the other hand, responds to resilience. Frequent adjustments feel productive. Constant information intake feels responsible. Refining strategy feels disciplined. But noise has a cost. It erodes patience. It increases reaction speed. It shortens time horizons. Over time, outcomes reflect behavior patterns more than intellectual ability. You can win arguments with intelligence. You retain assets with discipline. This shift changes the objective. The goal is no longer to appear insightful. It becomes something quieter. Maintain exposure. Control downside. Avoid irreversible mistakes. Money accumulates as a side effect of structure, not as proof of brilliance. When intelligence is not directed by discipline, it becomes expensive. Not because it lacks power, but because it lacks constraint. And markets test constraint continuously. There is a different way to think about capital. When I controlled entry points, my primary concern was not how often we would be right. It was whether we would survive when we were wrong. That distinction changes everything. Most participants focus on accuracy. They measure success by the percentage of correct predictions. They track how often their view aligns with the market. Owners think differently. They design systems where a single mistake does not cause permanent damage. Position sizing reflects uncertainty. Risk limits are respected even when confidence is high. Exposure is adjusted not to maximize excitement, but to protect continuity. The goal is not to win every cycle. It is to remain present for many cycles. Intelligence often pushes toward precision. It wants refined forecasts. It wants optimized timing. It wants to increase efficiency. Ownership emphasizes durability. If a position fails, the structure absorbs it. If volatility spikes, the portfolio remains intact. If assumptions prove incorrect, the impact is contained. This approach can appear conservative. It may seem less impressive in the short term. It rarely generates dramatic narratives. But over extended periods, it compounds. Because survival allows participation. Participation allows recovery. And recovery allows growth. The priority is not to demonstrate insight. It is to avoid elimination. And that mindset reshapes every decision that follows.